Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back to the deep dive. If you are tracking M&A, maybe scaling a portfolio company, or just really curious about how private equity firms actually generate those massive returns, then this deep dive is for you. We're slicing through a really crucial set of insights today. They're drawn from the experience of Altaline Capital Management, specifically Rafael Telahun, and shared via How to SaaS. Our mission here is to fundamentally rethink the timeline of value creation. We're tackling this core idea that maximizing returns has to begin aggressively before the deal closes, not after. Okay, so let's unpack the conventional problem. It's especially, I think, a big deal in the lower middle market where, time scarcity is lethal. The standard PE approach is to use diligence to identify these high-level strategic opportunities, the big themes.
Right.
Maybe it's we need to improve go-to-market efficiency, or there are clear synergies for cost savings. They're essential bullet points, but, well, they're just the start.
Precisely. That's the classic playbook. So the themes get identified during diligence, but the detailed the granular execution plans, the actual step-by-step blueprint of how.
Oh, exactly.
Yes, how the organization will achieve those savings or how they'll reorganize the sales team. That whole planning process usually only kicks off the moment the deal is finalized.
And what's the tangible consequence of that lag? Because I have to imagine when you've just leveraged a massive amount of capital for an acquisition, hesitation is, well, it's not your friend.
No, not at all. The consequence is a slow and a profoundly uncertain initial period. That critical first 6 to 12 months, which should be all about velocity, instead becomes this internal planning exercise.
So you're just spinning your wheels.
You are. You're burning expensive acquisition debt while senior leadership is still mapping out operational details, deciding who owns what, and often arguing about which tech platform to adopt.
Right.
You lose momentum. And in this game, losing momentum means losing margin. That critical first year gets wasted on drawing flowcharts instead of actually executing them.
Time is literally burning resources. So the firm that executes best is the one that de-risks that period by front-loading all the hard work. And this is where Altaline's perspective comes in. It's a disruptive strategy, and it's what really caught our attention. They advocate for what we're calling the Altaline mandate. Building 80% or more of the entire value creation plan complete with owners and milestones before the deal even closes.
80%.
80% ready to go on day one.
And what's fascinating here is that this isn't just about speed. It's really a foundational requirement for success, especially in companies that are, more resource constrained.
So why is it so critical?
Well, because it ensures that the 3 core pillars of the deal are completely synchronized and aligned from day one.
Okay, tell us about those 3 pillars again.
We're talking about the capital structure, the leadership team, and the detailed execution plan. If you wait until after closing to fully define the execution plan, you risk having it immediately clash with the financial realities of the deal. Think about the capital structure. If your acquisition debt has, say, stringent covenants that require rapid cash flow improvement or specific EBITDA targets in year one, your execution plan can't afford to be focused on long-term, high-risk projects. It has to prioritize immediate, high-certainty cost efficiencies and cash conversion. That alignment needs to be crystal clear.
So waiting for that alignment post-close just creates a bottleneck.
Immediate structural bottleneck. It can erode months of runway.
That makes total sense. The debt load basically dictates the action items, but 80% pre-close seems hugely complex. I mean, how do they navigate the legal and ethical tightrope of doing such deep, intrusive planning without, violating confidentiality or triggering regulatory flags before they even own the company.
That's the tension, right?
Yeah.
It requires a different, much more collaborative form of diligence. It has to move from being adversarial, from just gathering information, to joint blueprint construction.
Because they're building it together.
Exactly. Firms leverage things like transition services agreements, and they rely heavily on management cooperation. The deep dive isn't just on the numbers. It's a commitment from the target's management that they'll help build the new operating plan under a strict confidentiality framework.
And if they're not willing,
If the target management isn't willing to engage in that co-creation, it's a major red flag. It probably signals execution risk down the line, no matter how good the financials look.
okay, so we have the timing pre-close and we have the 3 pillars synchronized. But timing only works if the plan itself is solid. Let's move from the timing to the substance. What do these executable plans actually look like?
Well, the high-level bullet points we talked about, that's ambition. It's a wish list. The source is very clear. You can put improved sales comp model or optimized pricing on a slide, but those surface-level points, they don't create any value. They're insufficient.
They don't cut it.
Not at all. A strong value creation plan has to outline concrete execution details. It's the difference between a high-level goal and a fully detailed operational manual.
Can you give us an example?
Sure. So if the goal is, say, improve retention, the execution plan has to detail the specific processes that need to change, the new tech platform that needs to be integrated, the precise metrics that define success, and this is crucial, the named individual who owns the weekly success or failure of that initiative.
That level of detail forces accountability right away. If you don't know the how, you don't actually have a plan.
Exactly. It forces you to stress test your own assumptions. If your model predicts a 15% revenue increase from pricing optimization, the plan needs to show the new pricing tiers, the customer segments, the training for the sales team, the tech deployment schedule. Anything less is just guesswork.
This shift then from analyzing the past in diligence to blueprinting the future, it puts huge pressure on execution risk. And as the source notes, a lot of that risk is outside the spreadsheets.
That's so right. A huge and often really underestimated portion of execution risk sits squarely with the organizational team, the people. If your detailed plan requires a transformation in how product development works, but your current VP of engineering isn't equipped to manage that change, well, you've guaranteed failure, no matter how perfect the financial model is. So the plan must solve the people challenges before the close.
But again, this just seems like it would introduce massive friction. Isn't trying to identify capability gaps and even plan for personnel changes before you own the company a huge morale and legal risk? How do they navigate that tension?
It requires extreme sensitivity and a lot of structure. This human resource planning phase, while it's pre-close, is about assessing capacity against the future state. It's not about issuing pink slips. It's a gap analysis exercise.
Okay, so what does that look like in practice?
According to this approach, it involves about 5 key steps, all happening pre-close. First, early and transparent conversations with senior leaders. You have to assess their enthusiasm and their ability to lead what's coming. It's a fit assessment. Second, you proactively identify specific capability gaps in the team relative to the new plan. Third, you get explicit alignment on expectations for that future state. Fourth, you plan for third-party support consultants, fractional execs, to plug any immediate gaps.
And the 5th step, I'm guessing this is the elephant in the room.
It is. The 5th step is preparing for necessary personnel changes where they're required. Now, this doesn't mean firing someone pre-close. That's highly problematic.
Of course.
It means defining the new org chart needed to execute that 80% plan. And it means having the new talent pipeline defined, sourced, and ready to engage on day one. If you know the existing head of sales doesn't have the digital background for the new GTM strategy, the plan must include their transition or replacement immediately upon close.
So the pre-close planning forces the hard decisions on capability gaps right up front.
It has to.
That structural planning is essential. If the plan is ready, but the team isn't structured to actually execute it, the whole 80% effort is wasted. It's a bottleneck you designed yourself. So let's talk about the payoff for all this intensive pre-close work. If you build out 80% of the plan processes, tech, team structure, day one of ownership is fundamentally transformed.
It moves from an orientation to an activation. The defining feature of this strategy is that day one is not a ceremonial kickoff meeting. It's not where the new owners introduce themselves and the idea of change.
It's go time.
It is the immediate start of execution on the agreed-upon roadmap.
So if I'm a division leader walking in on day one, what does activation feel like? What's already scheduled?
It looks like operational clarity and velocity. The roadmap for the next 6 months is not only clear, it's already been communicated in principle to key stakeholders. Division leaders don't need a week to strategize.
They already have meetings on the calendar.
Exactly. They have specific sequence meetings scheduled with their teams to immediately chart and kick off the crucial first 180 days of activity. For instance, the new pricing committee meeting isn't scheduled for sometime next month. It's at 10 a.m. on day one. And that kind of immediate activation is only possible if the pre-close planning was truly comprehensive. To summarize that checklist for strong day one, you need clear plans across processes, technology, and systems.
Okay.
You need defined execution owners for every major initiative. You need a detailed roadmap for the first 180 days, itemized by week. And, critically, you need a plan to structure the right team to make the whole strategy feasible.
The 180-day roadmap, defined owners, and the team plan, those are the non-negotiables. It sounds like Altaline's approach fundamentally de-risks the whole investment cycle by shifting the question from, will we figure this out, to, are we executing on the known plan?
That's the core insight. By moving from high-level ambition to executable alignment before the deal closes, firms gain what is effectively 6 months of ownership immediately. And that just transforms the probability of hitting your year one targets.
We've extracted the essentials for you there.
So this leaves us with a provocative thought for you to consider. If execution feasibility relies so heavily on having the right team structure and defined owners, does the diligence budget and the time senior partners spend need to shift? Should they spend proportionally more time validating personnel and operational capacity rather than just focusing on historical financials?
And how early is too early to start charting the granular weekly actions of that 180-day plan? Something to mull over as you optimize your own integration strategy? Remember, these insights came from Rafael Telahun of Altaline Capital Management as shared in content from How to Suss. We'll catch you on the next deep dive.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.